Hello and welcome to The Insight by Oaktree Capital. I'm Todd Molz, and today I'll be having conversations with three Oaktree thought leaders. We'll discuss topics from Oaktree's recently published quarterly letter Roundup. We'll talk about why yields have remained higher for longer and what that means for credit investors, assess the historic stimulus package recently announced in China, and review the outlook for income-generating real estate. My first guest today is Danielle Poli, Assistant Portfolio Manager for Oaktree's Global Credit Strategy. Danielle, I appreciate you taking some time. We're heading into the holidays. It's a busy time of year, so I know you've got a lot going on. It's great to be able to sit down and chat with you today.
Hi, Todd. Thanks for having me.
Okay, Danielle, let's jump into it. Not that long ago, it seemed a slowdown in the U.S. economy or even a recession would push the Fed to cut interest rates at a rapid cadence. That hasn't materialized. Why do you think that is?
Well, in the U.S., a strong consumer and a resilient labor market has kept the Fed from cutting rates as much as the market initially expected this year. And the market has also reduced their expectations for as many rate cuts next year. U.S. growth measured by GDP has been revised up to 3.1% on the back of strong consumer spending and exports. And the labor market, while cooling a bit, still has a historically low unemployment rate of 4.2%, decent wage growth. The last quarter, we saw wage growth of about 3.9%, which is a level just a bit above what would be sustainable for the Fed to achieve its 2% inflation target. And inflation expectations have increased in light of this, and possibly also because of incoming President-elect Donald Trump's proposed policies, chiefly tariffs. But if you take a closer look at the U.S. economy, you look under the hood, if you will, there is a trend of bifurcation, and that makes the outlook look a lot less certain. So on one hand, the stock market has continued to reach unprecedented levels. You have many companies now with market caps over $1 trillion. And as the wealthy have seen their asset bases grow, they've increased their investment activities, and that's put pressure on prices in most asset classes. On the other hand, higher interest rates have hurt companies that have borrowed in the debt markets, as well as consumers lower down the income ladder that rely on financing and have built credit card debt from the higher prices of goods and have gone through savings that they may have accumulated during the pandemic era. And I think creating policy for both of these groups, or the average of these groups, is challenging for the Fed. And that it supports the Fed's decision to have cut rates by now 100 basis points from their peak to focus on this second, more vulnerable group. But it's also a reason why rates probably remain in restrictive territory, meaningfully above their neutral rate and well above where they've averaged for the past 10 years, just in light of the strength that we see in this other group. So what does all this mean? I think for credit, it means that the opportunity set is setting up very nicely. Investors can continue to benefit from above average yields, but borrowers and consumers are feeling some relief from lower rates, which is going to be supportive for fundamentals and a lower default environment.
That's really interesting. I'm just curious, amid this backdrop, what have been the main drivers of return in the credit space?
Against this backdrop of higher rates, income really has been the main driver of returns for credit. In public markets, sub-investment grade credit instruments have yielded on average more than 8% this year. And some pockets of the market, like double B rated CLOs, have even offered significantly higher yields than that. Economic strength has also contributed to spread tightening, which has given a boost to returns. This has pushed returns for the year of some sub-investment grade asset classes into double digits, making them competitive with average historical returns for equities. And perhaps more importantly, what hasn't driven returns this year for credit? It hasn't been falling rates, as many in the market predicted entering the year. So I do think the takeaway for this year, and frankly last year as well, is the power of the income. It's in the name, fixed income, as David Rosenberg, our head of liquid credit, always likes to remind us. And it offers investors the potential to earn above average returns in 2025.
It's an interesting environment, to your point. All-in yields do look attractive, but spreads do appear to be tight. You just mentioned income as a driver of returns. So what's more important to focus on now, yield or spread?
Well, I think you need to look at the whole package. We can analyze high yield bonds using the $1.3 trillion US market as an example and data from the ICE US High Yield Index as of the most recent month end, so November 30. At that point, the index's average yield was 7.2%. That's higher than the 10-year median yield, which was 6.3% before the Fed began increasing rates in 2022. So you're earning more yield than usual, and especially for other floating rate debt instruments like senior loans, which are yielding 8.5% compared to their similar historical yield of 6.2%. And let's also not forget that a few years ago, high yield was only yielding 4%, and you're getting double that today. Price also matters. The average price of the high yield index is 96.4. That means you can buy some bonds today still at a discount to par, offering the potential for price appreciation. And that leads me to spread. The high yield index today has a spread of 303 basis points, which is well below the historical average of 483 basis points. And the question that I receive most from our investors is this level too tight? But too tight for what? Continued spread tightening? Maybe. But if you're okay with a 7 to 8% earned through yield and potentially more than that through price appreciation, it doesn't matter if spreads tighten from here. And it did historically when yields were low and prices were high, but we do have the opposite of that today. Most investors agree with us that there is a case to invest on yield versus spread, but some investors do want to be more tactical and they want to time their entry. We think that that is nearly impossible to do, at least with any consistency. We strive to say near fully invested and then buy more in a spread widening event. But to help investors think more about spreads today, I would share the following. Removing the extremes for high yield, spreads are usually in a range of 300 to 500 basis points. Less than 300 basis points, there's not as much appetite to buy bonds. And above 500 basis points, not as many borrowers are excited about issuing them. We're at the low end of this range, but spreads can go tighter. Barclays actually recently highlighted some research that shows that the all-time spread tight for the high yield index was 233 basis points, and that was reached in May of 2007. And at that time, the index was substantially lower quality. By rating, it had less secured paper, it had longer duration than today. So a very different index. For example, double Bs, which is the highest quality part of the high yield bond market, they've grown in size over the past 10 years and now represent over 50% of the market today. So Barclays adjusted the index composition in May of 2007 to that of today. And what it shows is that the all-time tights for spread would have been 199 basis points. So this does tell us that there is the potential at current levels for spreads to continue to tighten. And while we aren't betting on that, it could happen. And importantly, if the opposite happens and spreads widen, high yield, the income that you're generating is so high, it will provide a significant buffer that wasn't in place years ago.
Well, it sounds like there's a lot to like about the yields on offer for those who would focus on yield. What sort of risks might they be overlooking?
That's an important question to ask. There's no free lunch. And when extending credit to sub-investment grade rated borrowers, extensive credit research is required, extensive underwriting. We earn high income and recoup our principal by avoiding defaults. Our co-chairman, Howard Marks, has always said, if you avoid the losers, the winners will take care of themselves. The defaults have been historically low, and most companies have navigated a challenging economic landscape over the last few years, and they've been able to get financing because capital markets have stayed open. We did see a spike in defaults in 2020 during the pandemic. But with those companies out of the market, the quality of the overall index has improved, as I mentioned. Still, there is bifurcation in the index. A number of companies still have over-levered balance sheets due to higher rates and may be at the risk of default without capital solutions. Many of those companies do have floating rate debt. They didn't contemplate a 500 basis point increase in base rates, and today they have a very high interest burden. Given the trillions of dollars in sub-investment grade markets, it's reasonable, we think, to be able to construct a portfolio of performing debt without having material defaults. And at the same time, leaving ample opportunity for opportunistic, distressed investors to provide capital solutions to the cohort of companies that will face trouble as their maturities approach, some now, but more so expected in 2028.
Well, it does sound like the current picture is generally strong. That said, we all know things can change quickly. Where do you think the market volatility could come from?
Well, real time, the volatility is coming from rates. The Fed's very hawkish December meeting sent rates sharply higher. The reality is that a number of the members of the committee are divided with respect to their views on how many cuts should occur, the timing of those, and their expectations for inflation. And those expectations could be overstated, and this might be a good opportunity to buy in a rate-led sell-off. At the same time, equity markets also reacted poorly to the Fed news. Equities need growth to deliver performance, and more rate cuts, which the Fed signaled there may be less of, those rate cuts would help stimulate growth and largely be positive for equities. The market is uncertain now if inflation could creep high and necessitate higher rates than had been contemplated. And when you see these types of volatile events pop up as market expectations are changing, they can be opportunities too to think about in terms of relative value and deploying capital.
Okay, you've covered a lot of territory. Boiling all that down, how do you think that should be reflected in portfolio positioning?
Our co-chairman, Howard Marks, has offered his wisdom on the question by suggesting each investor establish their own appropriate normal risk posture. And generally, they stick to it, though they may choose at times to shift their posture more aggressive or more conservative, depending on opportunities in the market. And it's Howard's belief, and I share this view, that today the markets are high, but they're not crazy high. And they're certainly not crazy low. And so it's probably time for normal risk posture, not for increased aggressiveness or defensiveness. And by and large, that's how the majority of strategies in our credit platform are positioned today. And within our multi-asset portfolios, we have the added benefit of being able to change allocations based on the market environment and relative value and stay positioned for anything that may occur in 2025.
Well, it's been a real pleasure chatting with you today, Danielle. Thanks for your time.
Thanks so much, Todd.
In my next conversation, we're going to move over to emerging markets, looking particularly at China. We'll explore the stimulus package announced by the government this quarter and whether it will be enough to revive the Chinese economy. For this discussion, I'm joined by Julio Herrera, portfolio manager of Oaktree's Emerging Markets Debt Strategies. Julio, great to have you on today.
Thanks, Todd.
Okay, let's jump into it. Julio, why did the Chinese government feel the need to introduce such a significant monetary and fiscal stimulus package? And how does it fit into their overall approach?
I'll start off by saying that this has been a multi-year stimulus push in China, which we can trace back to when Chinese bond and stock prices began their declines from the peaks 4 years ago. I emphasize multi-year. If you follow the media or brokerage research, they latch on to the latest so-called package and decide over a few weeks whether it worked or not. That is not how we should analyze policies of the world's second largest economy. Chinese policymakers don't have itchy fingers or poker-like gamesmanship right now. Their leaders do not believe in quick fixes. For example, we're years into this stimulus push, and only in recent weeks has China finally changed its official monetary stance from, quote, prudent, unquote, to, quote, moderately loose. To your question of why, there's some well-known problems in the Chinese economy. China's growth rate has been declining, consumer confidence is at record lows, and there's a lot of debt in the system, including at the local government level. The real estate sector, once 30% of its economy, is struggling and has had a sweeping number of debt defaults. However, we do see green shoots. We've started to see property sales grow versus last year's levels through December.
That's really fascinating. You mentioned that China's been focused on revitalizing its economy and property sector for years now. Can you share why there's been a bigger easing effort at this time?
Well, Todd, We can only wonder about the exact pain threshold of the Chinese government. I'll speculate that the reasons for the latest pickup are within 4 general categories. First is that after 2 years of hundreds of measures making credit available and relaxing regulations in the real estate sector, policies haven't seen the results they wanted yet. Now they've finally decided to stimulate demand further, moving away from study, tactics, and exploration. Second, since government policy tightening contributed to the prick of the housing bubble to begin with, the government is very interested in being seen as driving the solution. Third, China is eager to move up the value chain, including high-tech manufacturing and electric vehicles. But it also needs to shore up its social goals of, quote, common prosperity, unquote, and a better quality of life for its people. There are 1.4 billion people to keep happy. These people went through a challenging pandemic period. They bought apartments that haven't been delivered, and at least 200 million of them are still working to make it into the middle class. And finally, the most important point, Trump. The great game is on now. China is still trying to buttress its economy so that it's well positioned for a potential tariff war 2.0.
That really paints a picture of what's going on beneath the surface. And to that end, past the headlines, can you outline some of the details of the package?
Todd, the specifics are classic textbook reflationary policies, and there's a lot of them. I'll start with 5 of them that we'll identify. China reduced the amount of money banks must keep in reserve by about $140 billion by lowering the reserve requirement ratio. This money can be lent to businesses and people. Second, they lowered the short-term interest rate by 20 basis points. Rates are now at a record low of 1.5%. Third, they injected $70 billion in cash to the financial system to support companies, which includes equity buybacks. Fourth, they laid out a plan to swap $1.4 trillion in local government debt onto the federal balance sheet. If you're not familiar with this issue, it's a big point of contention. The numbers really are not well known. The reporting is hard to pinpoint, but local governments have used special vehicles to raise large amounts of debt, and reporting has not been that transparent. Fifth, they've updated their official economic rhetoric. So there is a lot more to come. For instance, China is now advocating for, quote, extraordinary countercyclical measures to support growth. They've expected to keep the growth target around 5%, and they formally shifted to a, quote, moderately loose, unquote, monetary policy. I put these in quotes because everyone's trying to read the tea leaves, just as economists try to read the tea leaves when the Federal Reserve publishes something in the US. The way China is providing these updates has gotten a lot bolder by announcing many of these policies together on a single day. Remember, form is important. It was the first time they did so since 2015. And in October, we saw a rare unified briefing by 5 government departments.
I'd like to actually move for a moment to focus on the property sector. Could you talk a little bit about some of the government's specific actions in that space?
Real estate reflation is always a tough nut to crack. It was tough to crack in the US. It was tough in Greece and Spain and Portugal after the worldwide financial crisis of 2008. China started the reflation process for the property sector by loosening administrative regulations over the past 2 years. The context of these deregulatory housing measures occurred when more than 80% of the bond issuers in China's real estate sector defaulted on their debts and the construction of new homes ground to a halt. The government is now pulling all the levers, and I mean all of them, to stabilize the real estate sector. In September, for the first time, policymakers said they wanted to, quote, stop the decline, unquote, in the real estate market. Banks are being told again, state-owned banks, to lower rates on existing mortgages, which are already just above 3%. Down payment ratios were lowered for second homes. The government is supporting the banks with liquidity in several ways: to buy back undeveloped land and unsold homes, and there is an expanded $500 billion program to finish real estate projects that you often see in the Western press as incomplete. Cities are also expanding programs to make it easier to buy homes across various regions, which can unlock further demand. There are hundreds of millions of migrant workers who face restrictions on buying homes. That's probably going to be loosened, perhaps eliminated to spur even more demand. All of these measures seek to rekindle home buyer confidence, which is not just a financial matter, but a psychological condition.
You say the government's pulling all the levers. I think that brings us to the big question. Will it work? Will this package, will all these actions be enough to solve China's problems?
Todd, that's the bonus question. Seriously, though, I'll quote Howard Marks on this one. We are still, quote, optimistic on China's long-term possibilities as long as they execute well and as long as they remain constructive with regard to the rest of the world. I agree with that. China will always be working on fine-tuning its economy. Many people wonder whether China has the capacity to keep easing, since what they've done so far hasn't achieved its own goal or change market perception. When you look at some of the headline stats, it's a fair question. Some economists estimate that China is running high deficits of 7 to 8% of GDP. China's interest rates are around 1.5%. This is already among the lowest globally. China has high debt levels. According to IMF data, debt levels are more than 100% of GDP. And China's FX has been weakening. On this point, which is a crucial one to US politicians and policymakers around the world, many people think that China wants a weak currency to promote and stimulate trade. China, though, has other incentives. They want to be the largest economy in the world, they want to defend the cost of their imports, and they want to protect their people's wealth. So there are some checks and balances to this. And so China faces many constraints, but we think that they have room to continue their policy effort because they check a few boxes that not many other countries in the world can rival. First, China has a current account surplus and the world's largest foreign reserves, supporting its liquidity and currency position. Together, China and Hong Kong have the largest net lending book in the world. A lot to be said for that. Second, the IMF estimates China has $12.5 trillion in financial assets when you include their equity stakes in state-owned companies. That's an enormous asset base that can be mobilized. Third, those assets could be used to influence consumer behavior. There are an estimated $20 trillion in bank deposits that could be unlocked if corporates and consumer sentiment shifts. Fourth, China hasn't done a direct consumer stimulus program yet, like the US COVID checks. Instead, for now, they're promoting consumer good trade-ins and producer subsidies. Finally, it comes back to China's strength in the world, politically and in the economy. Remember, China has the world's largest labor force. This allows long-term capital to be patient.
You mentioned earlier that there's some skepticism in the market around some of the stimulus, and investor sentiment does remain negative. But can that also be a source of opportunity?
Todd, as you well know, bargains appear when asset prices have collapsed, investor sentiment is pessimistic, and in this case, dire. While we don't know if China can calibrate its economy for the delicate balance of sustainable but not excessive growth, the equity and bond markets continue to discount a subpar outcome. That said, China's $18 trillion economy is growing close to 5% per year, and company earnings continue to grow at close to 4%. I believe that careful analysis of the cast-offs in the markets can lead to identifying bargains that more than compensate for the macro and micro risks. Now, coming back to the core of our talk today, China's stimulus. We're optimistic about China's direction of travel, and we think that their policy reaction function is working. We'll be watching the impact and the continued rollout of China's easing measures into next year.
What a great way to wrap up that discussion. Thanks, Julio. I really appreciate your time today.
Thanks, Todd.
For our final conversation today, we're going to look at the real estate sector, which is showing signs of stabilization following a protracted dislocation. For this discussion, I'm very happy to be joined by Mark Jacobs, co-portfolio manager of the Real Estate Income Strategy. Mark, thanks for joining me.
Thanks for having me, Todd.
It's no secret that real estate has been in a tough spot the last few years. But in your piece, you write that core and core plus valuations have been pressured more by higher rates than decline in the fundamentals. Could you elaborate on that a bit?
That's correct, Todd. If you look back over the last 2.5 years, we went from an interest rate environment where we had zero interest rates to over 5% interest rates in a very short time. In fact, it was the fastest increase we've ever seen. And that caused a big negative downward pressure on valuations for core and core plus real estate. We're now adjusting to a more normal interest rate environment. If you look back at previous periods where we saw a big decline in real estate values, most of those periods were associated with one or all of a combination of massive overbuilding, excess leverage, a deep recession, where you had significantly weakening fundamentals across the real estate sectors. That just isn't the case today. As we know, the U.S. economy is doing fairly well. GDP is positive and growing. Outside of office, fundamentals across most real estate sectors are relatively balanced. We still have a housing shortage in the United States. And on the debt side, we've actually seen some pretty positive signs that the debt market has come back to life this year. So getting back to your original question, seems like most data points seem to point to the fact that the rapid rise in interest rates was the main cause of the downward pressure in valuations.
That's really interesting. I mean, you mentioned a few different sectors in real estate there. I wanted to just zoom out and ask you the question generally. So the term real estate, it does contain a multitude of sectors. In your view, which ones have been struggling and which ones have been more resilient?
Well, clearly the struggling is pretty simple. It's office. By far the most impacted sector across all real estate. And there's lots of reasons for it. We probably don't have enough time to go into all of them, but I think they've been well publicized and most people are familiar with them. On the other hand, one of the sectors that's been the most resilient is just housing overall. This would be for sale along with rental, including multifamily, single family for rent, and student housing. And the reason for that is simply that we're undersupplied in housing overall in the United States. Various research firms predict that we're short anywhere between 2 million to upwards as high as 3.7 million of units. That's both single family for sale and multifamily. And with single family construction starts still tracking below historical averages, it's going to take some time for us to build our way out of this shortage.
Just picking up on your mention of the shortage in supply, particularly around the multifamily segment. What's going on there? Why is the supply so constrained, and why does it seem like it's going to be constrained for the next few years?
Well, just to clarify, over the last couple of years, we have seen elevated new supply in the multifamily sector. Given the strong demand that we've seen, there's no surprise that we saw a lot of new developments. However, most new supply peaked in 2024 across the United States, and is predicted to drop significantly, almost by half in 2025, and further in 26 and 27, back to levels we haven't seen all the way since 2014. This high level of supply over the last few years did lead to slower rent growth. However, based on a number of positive trends, it's quite possible that you could see above average rent growth over the next few years. One of the trends we've already talked about, which is simply just supply overall, is falling dramatically. Second, economics continue to favor renting versus owning in the United States. The monthly spread between owning and renting still is at a historical high. And in fact, the median age of first-time home buyers is now 38 years old, which is a new high as well. And the last point I'll make is wage growth continues to be strong in the United States. If you coupled that over the last couple of years with slower rent growth, rental affordability has actually improved. So overall, pretty favorable trends when you think about the next couple of years in the multifamily space.
That's great. I'd like to just stay on this point a little bit and talk a little bit more about multifamily. I'm curious, what regions or property types stand out as offering the best value? What factors, when you're thinking about these kinds of things, are important to you when underwriting new transactions?
There's a lot to consider, but pretty simple when it boils down to it's supply and demand. Those markets where job and population growth remains relatively high and supply is relatively low are the most attractive in our minds. We still favor high growth markets like the Southwest and the Southeast. However, there are some coastal markets that are also starting to look pretty attractive. In addition to supply and demand, we take other factors into consideration. We tend to favor lower density, highly amenitized projects with lots of outdoor and gathering spaces. People through the pandemic have learned that they want more space, and those projects that can offer that obviously are more in demand. Outside of just physical real estate attributes, we also take into consideration the local and state political environment, the local labor market dynamics, personal income tax rates and property tax rates, and then how expense volatility can play into the underwriting. So there's a lot to take into consideration, both in terms of the design, the location, and then also other factors that can impact the desirability of multifamily today.
That all makes sense. So we've talked a fair amount about the impact of supply on the real estate sector. Maybe we could talk a little bit about the kind of financing side of the equation. What kind of trends are we seeing in the debt markets for real estate?
That's actually been one of the bright spots this year. Liquidity has definitely increased throughout the year on the debt side, and the cost of capital has come down at the same time. CMBS volumes have picked up dramatically, really filling the gap left by the banks pulling out of the market the last couple of years. Today, we have a very normal, healthy, functioning securitization market. Year-to-date volumes are similar to what we saw in 2015 and 2016, which was a pretty good time to be investing in real estate. As I mentioned, at the same time, we've seen the cost of capital come down as spreads continue to tighten after hitting a peak about 18 months ago. So this increase in liquidity and lower cost of capital has really led to an increase in transactions, a trend that we definitely think is going to continue in the 2025.
Okay, I saved my toughest question for last. The office sector has been marked by the most negative sentiment. Is it truly an uninvestable sector, or is there a prudent way to invest in this space?
We can dedicate a whole podcast to office in itself, but just a few high-level thoughts. I will say that we do think there's going to be more pain in the office sector, and it's not going to recover quickly. But we are starting to see some early positive trends, such as an increase in the return to office. And while this recovery will likely take some time, I think those high-quality office assets in the right markets and the right locations continue to perform well, and going forward should continue that performance. So the last thing I would say is if you can access those types of assets, even if it's office, through probably a restructure of the debt or in the debt at a reduced basis, then potentially those investments could be profitable. But time will tell with the office space for sure.
Well, Mark, that was a really great discussion. I appreciate your time, and those are some interesting answers. So thanks very much.
Thanks for having me.
Notes and disclaimers. This recording and the information contained herein are for educational and informational purposes only, and do not constitute and should not be construed as an offer to sell or a solicitation of an offer to buy any securities or related financial instruments. Responses to any inquiry that may involve the rendering of personalized investment advice or affecting or attempting to affect transactions in securities will not be made absent compliance with applicable laws or regulations, including broker-dealer, investment advisor, or applicable agent or representative registration requirements, or applicable exemptions or exclusions therefrom. This recording, including the information contained herein, may not be copied, reproduced, republished, posted, transmitted, distributed, disseminated, or disclosed in whole or in part to any other person in any way without the prior written consent of Oaktree Capital Management LP, together with its affiliates, Oaktree. By accepting this document, you agree that you will comply with these restrictions and acknowledge that your compliance is a material inducement to Oaktree providing this document to you. This recording contains information and views as of the date indicated, and such information and views are subject to change without notice. Oaktree has no duty or obligation to update the information contained herein. Further, Oaktree makes no representation, and it should not be assumed that past investment performance is an indication of future results. Moreover, wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. Oaktree believes that such information is accurate and that the sources from which it has been obtained are reliable. However, it cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. Moreover, independent third-party sources cited in these materials are not making any representations or warranties regarding any information attributed to them and shall have no liability in connection with the use of such information in these materials. Copyright 2024, Oaktree Capital Management LP.
Audiation.